Good afternoon, good morning for those of you that might be dialing in from a non-Asia region. Thank you for joining our webinar to discuss credit risk management given the recent market turmoil. Credit risk and credit risk management has always been top of mind for many risk practitioners, but maybe over the last couple of years it's kind of taken a back seat due to the low interest rate environment and lower NPL ratios over the last 4 or 5 or even 10 years. But recent market turmoil related to interest rates, IRBB liquidity, and operational resilience, not to mention Basel III, has also overshadowed credit risk. But good old-fashioned credit risk management is being brought front and center again, at least in this part of the world, due to recent rapid rises in interest rates, current volatility or turmoil in the commercial real estate sector in the region and globally, as well as counterparty credit risk concerns and stress in the SME sector. Historically, we've looked at very low NPL ratios across the banking sectors in this region, but regionally and globally that may be changing as we move to more volatile macro and geopolitical landscapes going forward. Thus, banks and financial institutions may need to look at the way that they manage, quantify, and report credit risk in this new volatile environment. Today, I have with me 3 excellent speakers and practitioners that are going to share their experience. And I'll first start by introducing myself and then moving on to them. So I'm Michael Monteforte. I'm a partner with KPMG here in Hong Kong. I have a credit risk background and I focus on risk consulting for banks here in Hong Kong as well as regionally and globally. Trevor, if you'd like to introduce yourself briefly.
Yeah, thanks, Michael. Yeah, Trevor Late, Chief Risk Officer for CIMB. Approximately worked about 20 plus years in Asia Pacific. So quite extended experience across Asian Pacific markets on credit risk and market risk and liquidity risk. So thanks, Michael. Happy to join the panel.
Thomas Oliver.
Hi, I'm Thomas Oliver. I'm the head of model validation for Quantify. My background is a risk quant, primarily both creating and validating different valuation and risk models, mainly for investment banks such as RBS and JP Morgan. So very happy to join the call today.
Great. And finally, Michael Yap.
Thank you, Michael. Michael Yap with Maybank, model risk management and the model validation in credit risk and the FRS 9 model. So been in the industry for 22 years now. So happy to join this webinar. Thank you.
Great. Thank you very much for the introduction. I think before we start to break out into the individual topics and discussion points, we'd like to start with one polling question, which I'll read out. And then if all of the attendees, if you can just spend 30 seconds to try and answer that. So which aspect or what aspect of credit risk management is top of the agenda now where you are employed or where you work? So IFRS 9, ECL, and loan provision management, stress testing of non-retail credit portfolios, for example, CRE, commercial real estate, implementation of AI and machine learning automated credit decision engines, NPL management and restructuring of bad debts, or internal credit rating models. It'd be interesting if we could kind of share the polling results as they come in the next 30 seconds to 1 minute. But I'd also like to mention, in addition to this polling question, we do have another more detailed poll that we'd like you to look at as we go through the webinar. There's another survey that you can answer. There's a pop-out window for that. And we encourage the audience to kind of look at that and answer it as we go through the webinar. So when those polling results on the first question are out, we'll try and pop those up. I don't see them right now, but I'm sure that they will be made available. Oh, there they are. Okay. So it looks like, interesting, 13% for IFRS 9 ECL, stress testing of loan portfolios, implementation of automated decision engine, NPL, and restructuring. Interesting that those two are kind of tied These may change a little bit as more results come in, but essentially it looks like the top two are stress testing and NPL management and restructuring of bad debts. So that's kind of a nice segue into the first topic that we'd like to discuss. And again, I'll remind all the participants today that there is a chat box where you can type in questions, and those will be fed through to us as we go through the webinar. So point number one, impact of the regulatory and macroeconomic environment on credit risk management. So I'll start by just providing a little bit of a view on where I sit here in Hong Kong. Relatively benign credit scene, I would say, over the last 5 to 10 years, with generally speaking, low NPL ratios. I think, things are starting to change. So, we do see some stress in the credit space coming from the mainland, the commercial real estate sector, potentially the SME sector, grappling with the higher interest rates and working capital loans. I don't really see anything incredibly alarming at this point, but I think banks are starting to revisit the loan portfolios, taking a sector view, at least when it comes to loan loss provisions or IFRS 9. Maybe they're reassessing the staging criteria, and potentially what we've seen is some targeted reviews of specific credits, looking at whether some adjustments need to be made, additional loan loss provisions, or potentially more frequent review on the credit ratings, internal credit ratings for those type of exposures. I think from the regulatory landscape or regulatory point of view, we have the Hong Kong Monetary Authority. Of course, Basel III has been discussed at length. It's being currently implemented as we speak, with a deadline of June 2024. And of course, when it comes to credit risk RWA, there will be an impact on capitalization for credit risk. Hard to say whether overall it's up or down. It's very product specific. But the impact seems to be quite manageable, at least at this point in time. Other things that the regulator is focused with here in Hong Kong, the automation of credit approvals, and they've got an initiative called the CDI, the Commercial Data Interchange, where essentially it's an alternative data platform where banks can share anonymized data for SME type exposures, looking to automate credit decisioning, which is something that the regulator is focused on. There is a bit of a concern, I would say, on things that are very specific to Hong Kong when it comes to Lombard loans or margin type credits, margin lending. And there's been some targeted reviews in that space, as well as some ad hoc reviews when it comes to collateral management. So that's a bit of a scene in terms of what's happening here in Hong Kong. Of course, Hong Kong very connected to the international banking system, and it isn't, one of the world's IFCs. So what happens in other regions is critical here, and the Hong Kong dollar being pegged to the US dollar, obviously interest rates are lock in step there. So again, the higher interest rates are starting to trickle through, and I guess renewing a focus on good old-fashioned credit risk management practices. So maybe Trevor, if I can hand over to you now, and you can potentially give a little bit of a perspective from your experience at CIMB and other institutions in Southeast Asia. Thank you.
Yeah, thanks, Michael. I think that's a great introduction. I think the way we're seeing things now, historically we've had historical low interest rates. We've had very supportive fiscal policies from governments, particularly during COVID time, where they were pumping in a lot of money and equity back into the market. So now, as you're seeing fiscal policy pull back and also interest rates rapidly go up, obviously we're seeing definitely stresses across multiple industries and sectors and countries and markets on credit risk. And so I think, like you said before, over the last 5 years, credit risk has been probably a little bit step back, and it's been more on some other particular issues. Now it's going to come back into the forefront of actually what banks need to really manage. And so you probably saw in that poll there, obviously a lot of people are looking at provisioning now, write and provision. And the second highest question was about, polling was about how we manage those. And they're probably going hand in hand, because actually when you're looking at the stresses in your portfolio, you got to start doing, a lot of banks and a lot of regulators are now pushing for banks to actually start doing stress test scenarios on higher interest rates, less liquidity in the marketplace. And then from that, when we're seeing early deterioration in some of our sectors and markets, then that second part of that polling is, then you have to manage those. And so I think that's now going to be back to where the banks are going to be looking to increase their provisions, particularly looking probably into 24, where we're looking probably at potentially high probability of recession in some of the markets. And then also how we're going to manage those to make sure that we don't have too much of an impact on the bottom line of the P&L for most of the banks. So yeah, I think that's now going to be probably the front and center of attention for the rest of this year and into 2024. And you can see also just recently, another factor is actually not just the government or macro indicators, actually environmental factors. You're seeing heat waves in Europe, we're seeing fires in North America. So even environmental climate change now, ESG sort of factors, which were not as high profile, but now we're seeing those impacts across a broader level, a macro level, which actually now it's impacting the economies of certain markets and certain trade sectors as well. So I think that's now going to come into even more stronger play going forward as well, Mark.
Yeah, that you brought up a good point, and I forgot to mention was the climate risk. At least in this part of the world, the HKMA is quite advanced when it comes to their views and requirements on climate risk management. The banking sector here is full speed ahead with climate risk stress test 2.0. And banks are starting to take it more seriously in terms of how to incorporate transition and physical risk into the credit risk quantification process. So things like including transition risk or physical risk factors into the actual credit rating models themselves, or into their BAU stress tests. Those risks haven't been capitalized yet, i.e. RWA, but we would think that at some point the regulators would require some kind of Pillar 2 add-on when it comes to climate risk. So really good point, top of the mind for many institutions.
Yeah, exactly, Michael. I think the really important one is the transition one, because when we were looking at, back when I was with HFC, looking around the industry sectors, the actual bigger risk is if industry or a company doesn't transition, because that actually has a big impact onto their future P&L status and how they're actually going to generate revenue. So there's certain industries and sectors where that transition risk is really, really huge. And now our banks are only just starting to explore, like you said, how we're going to actually start to incorporate it in credit decisioning, and then also how we're going to actually start doing the capital, which is not in there at the moment. But yeah, I think that's now going to become even an important factor, right, going forward.
I think one of the challenges, and then we'll let our other speakers jump in here, but it's generally speaking, banks will look at your kind of BAU credit risk as a one-year horizon where the transition could be 5, 10, 20 years. And, how do you kind of reconcile between the two? And I think at least when I talk to many of our clients who have, completed relatively robust climate risk stress tests, the challenge they get back from business is, okay, great, we've quantified climate risk and we've transmitted that to a credit risk metric, expected loss. But what I need to know is, what are the top 20 or 30 counterparties that I need to start transitioning away from right now, because that could be a 3 or 4 year process. And that's what I would like to know. So, transition risk is real, as you said. Banks need to start taking actions now to transition away from those industries and those counterparties. And that is one of the value adds, I think, that has come out of these climate risk stress tests. I mean, physical risk is a separate thing, but at least from the transition side, yeah, you hit the nail on the head. Maybe over to Michael Yap. if you have any kind of insights, providing a bit of perspective on your jurisdiction, what you're seeing, and generally speaking, what are some of the key credit risk themes?
Thanks, Mike. So I think in this part of the country, especially the Malaysia and in the Malaysia perspective, I think there's a lot of government support during the COVID period. And we do actually during the period that we have built a series of a scenario to kind of to support and quantify how this will actually impacted the model. As we all know, I think the provision models only come about back in to this region around 2017, 2016, and somehow we went into this pandemic period. And of course, that those that are what actually the component that be part of the model is also affecting all the particular models that are built for capital or even for provisioning. So in a way that there is a lot of initiative that going towards the analytics in part of the credit decisioning, but this period is also a kind of give feedback to the bank on how to actually to look into these numbers and then how it's impact the particular risk. Especially like the what you mentioned, Trevor, that climate risk is a part of it when we kind of the transition risk, that when we look into the modeling part into this particular area, especially when we gather the feedback from the business and from the stakeholders, we also be very mindful that we don't want to build a kind of a complicated models around this climate risk for now. And then we do see that you need to get a lot of the stakeholders understanding on how we actually brings all of them to the same platform. And that's why the bank per se also have launched quite many initiatives around the ESG drive as part of our agile of our M25 25 plus plan going for the next 5 years.
Yeah, you brought up a good point on the COVID. I mean, at least from the clients I've talked to or worked with, one of the, I wouldn't call it a challenge, just something that's on the to-do list is to review all of the adjustments or enhancements that were made during the COVID pandemic to the credit models or the stress testing models. And now that we're out of COVID, a lot of those things need to be unwound. So for example, where you've got government relief measures supporting the SME sector, those are being unwound, and therefore, does that mean that in itself could present a risk to, from a credit angle for those clients or not? And then where you've factored in COVID overlays or stress scenarios that are linked to COVID, that needs to be unwound. And some institutions have done that already, some haven't, or in the process. So, it's just something on the to-do list. I think we've got a question that has come in, essentially saying, how do you integrate geopolitical risk into a credit risk management framework and credit decisioning? Yeah, look, at least in what I've seen and heard, when we run our kind of client emerging risk forums or discussions on limits and risk appetite, I mean, there are specific scenarios like the two you mentioned here. And, banks have those scenarios carved out, at least more sophisticated banks. And they say, all right, this is one scenario that we need to idiosyncratically run and say, okay, we carve out all of our exposures that we think have direct or indirect exposure as a result of this scenario, and then stress it and see what happens. And the results aren't pretty. But again, I think it's, about degrees here. And, of course, for these type of scenarios relative to 10 years ago, the probability may have increased, but it's still a smaller probability, I would think. But again, I think stress testing is the way to do it. And that should have a probability weight to the scenario, which might be quite low. So the aggregate impact may not be enormous at this point. But that's how you would kind of transmit it to credit decisioning and credit limit setting. And again, there's indirect exposure, which is a bit harder for those banks, institutions where they don't have the direct exposure, but they do need to have a thought process saying, if these scenarios happen, how would it impact our credit risk, whether it's looking at direct exposure, indirect exposure, industries that supply to other large corporates that are directly exposed to this or not. So yeah, not easy, but I think stress testing is the way to do it. It looks like we've got some updates to the poll again, focusing on stress testing of non-retail credit portfolios seems to be in the top spot, with everything else tied, except for the AI and machine learning, which has taken the lowest score, which is quite surprising because the more that I've worked with banks, we keep getting questions or inquiries saying, how can we use rules-based credit engines for the SME or middle market sector, as opposed to having credit officers reviewing each file again and again. But maybe that's been put on the back burner by some of the participants. So maybe we can kind of jump into the second point, which is a bit more of a deep dive on credit risk from a technical or techniques point of view, and then some of the challenges given all the changes in the macroeconomic environment. And maybe Michael Yap, I can pass over to you and you can provide a few points. Maybe this is around how you assess validation of credit models, development or re-optimization of your internal credit models, or stress testing models related to credit. Yeah, early warning indicators, etc.
Yeah, thanks. So just one would like to highlight maybe three main things that we've been observing and has been happening, particularly in this banking industry, and as we actually emerge from the pandemic. I think that what Mike have highlighted is very true, that I think for the last 2 years, we have been looking very hard on the small, medium enterprise and how do we actually support, as in the country like Malaysia, we do see that they are quite form the backbone to the economy. And we do see that the current, the scorecards that has been built, I think in a way that they need to be more speed and need to be more agile, and the use of the non-traditional data to kind of support the credit decisioning. And that's why we, for the Maybank, we do actually launch this digital loan initiative in a way that to promote the alternative way of looking the scoring of this particular business segment. And that's where we use a lot of the non-traditional data. And the thing is, we use some of the machine learning, the latest technique, and then to look into it, and then to kind of to build it a parallel against the existing the regression method of the modeling. And we do see that actually give some traction and to untap certain market that the market segment that are being deprived from the traditional credit. And we do see it that this is in a way that how do we actually leverage on the analytics to kind of to relook the credit risk management in a way. And the secondly, also I would like to kind of share that managing credit during the volatility time is also required that there's a lot of a stress test that kind of exercise being looked into. So we will look not just for, especially for the non-retail, it's not purely from the bottom up, but also from the top down. And as such, also the bank is also looking more different methods to look into how to improve the current the scenario building, and how does actually the input of all the economics variables that can drive the building such scenarios. This is also being kind of during the feedback with the regulator. They do see that there are more submissions or more sharing of this scenario testing, as particularly during the pandemic, in the absence of the kind of like what we have seen today, the lack of default or lack of and huge support from the government. So you do see that there are a lot of muted, or there's some kind of the absence of the kind of event that can really the traditional way that how do we look into the stress testing the outcome. And that is something that is continuously going to be built on. On the third point, actually there is one thing we do see that the thing is also looking the existing framework. We do know that I think for the banks to kind of to respond or to react things, the events that happened during the pandemic, it taken the banks aback, and then we do see that we may actually able to respond it more effectively, more in a more agile manner. So that's why we also kind of relooking our frameworks, our policies to make it a more agile way, and it need constantly to be reviewed and constantly to be more the agility on how it actually responds to the volatility in the market and the changes, so that it actually able to kind of take the industry feedback, the customers' feedback to actually to adapt to the changes, particularly the use of the analytics when we build taking all the outcome from the particular the events that happen, so that we can reflect and then translate it inside the particular framework, so that when the business actually understand that particular the kind of the risk appetite that was understood, so that it can flow even faster to the industry, so that it able to support the whole ecosystem. Yeah, that's the 3 points that I'd like to share. Thanks.
Okay, interesting. I've got a point I'd like to make, but before that, I'll just see if Trevor, from a bank practitioner's point of view, if you have any thoughts on techniques, any kind like recent developments when it comes to quantification of credit risk and management of credit risk.
Yeah, I completely echo from Michael's comments. It's all about alternative data sources now, which is really where we're supplementing traditional credit risk models. So all the banks are really playing catch up in this particular space here and doing a quite large investment. Whatever bank you talk to is working in this particular area. And I think what you're seeing more and more of, obviously, data is king. So the more data you have, the more insights you have on a particular customer. It doesn't really matter if it's retail, SME, business banking, or global markets. And so you're going to see a lot more engagement with banks, whether it be through partnerships, where we've partnered with different, Amazon, could be through economic platforms, commercial platforms where you can get data from, or could even be data aggregators, players that are around the world that actually aggregate certain pieces of data. And then we've even seen a lot of that space in the ESG side, where actually, where traditionally ESG data has been quite poor. So we're seeing a lot more activity with the different governments mandating certain data requirements, and also we're seeing aggregators pulling in certain data so you can actually measure certain ESG requirements. So yeah, pulling all this data in, data is key. With banks working with partners, with governments, etc., to pull in the data, and then using obviously machine learning alternative models to actually build those, enhancing all your credit risk models from that. And then we're seeing a lot of banks now digitalizing the middle and back office of credit. So that's now been so the digital transformation programs are running across different banks, where they're now obviously using that data, using the models as tools to enable better efficiency across the whole credit onboarding process and management process, portfolio management process. So you're going to see a lot more activity around, okay, once the tools have been built, once you've got the data, how can we make efficiency across the whole credit process, whether it be onboarding from portfolio management to offboarding and NPL and bad debt management. So all that's going to see, sort of transformational changes in those different sort of sectors and areas as we start to build these enhanced tools across the different areas to be able to make better decisions than what we've traditionally been through judgmental.
Yeah. A couple of points. So I've been fortunate enough to work with a few clients here on a discovery project where we've sat down and we've basically done end-to-end reviews on the non-retail credit journey from customer acquisition all the way through to disbursement, or basically a time to cash analysis. So from the time that we onboard an SME middle market client, how long does it take till they actually get the first drawdown on the loan, and all of the things in between where we can automate using some tools and ideas that we have and digitization. So that was really interesting. I think in this region and this part of the world, there's a lot of work to be done. And the virtual banks. So in this market, there are 8 new virtual banks that have come basically that were approved by the HKMA and are slowly building up their own loan books. And, they are not grappled with the history of a lot of legacy systems and issues. So they've been able to leapfrog a lot of that, in some cases, automating huge amounts of traditional credit risk practices, or processes, I should say, when it comes to onboarding, credit reviews, credit file management, credit approvals, etc. So that's very interesting. But what I'd like to ask you guys, I was on a interesting internal meeting with some colleagues at KPMG in New York, and they're running a few client engagements there, kind of related to credit risk, where they're using a chat GPT tool to basically run stress tests on credit portfolios. And those models or those tools actually, write all the code. And of course, there's a little bit of human in the loop there to refine things, but essentially they're just continuously stressing credit on a real-time basis. It's not put into production. It's just an exploratory piece of work, but it's really interesting because they keep, consistently learning and pulling in new data sources as well as new macroeconomic variables to come up with the best outcome, let's say, however you define that. But it is going to be applied kind of like a credit portfolio type of process. So, I don't know, maybe Trevor, is that something that you guys are looking at in your institution?
Yeah, Michael, yeah, you are. And again, it's explorative. Some banks are working with, universities or other areas that are exploring that. But yeah, I think it's definitely going to be, it's not just, it's across the whole banking industry. It's not just in, but we're obviously here talking about credit risk, etc. But it's quite across the whole industry how those particular tools are going to really change the way that we analyze stress tests, make the decisions. But again, it's going to be important to have the data, right, to support and feed into those models to get the better decisions. And then it's going to be about it's going to really mean they're going to have really strong risk appetite, limit settings, type strategies, so you can give the rules of engagement, the playing area which these tools can play within. So that's going to be where the next development is going to be around, because, obviously you're not going to have less and less judgmental and policy rigor. Therefore, you're going to be pumping in data into these models. They're going to be making decisions, but you're going to have to give them guidance. You're going to give them some rules and say, okay, where they need to play within that playing field. And that's that's what needs to be set up. Because at the moment, we're relying on people to do that, but then now we're going to have to sort of set those boundaries up.
Yeah, I think, at least my understanding over there is the regulators are starting to warm up to the idea of using those type of tools, chat GPT and, generative AI models in certain types of risk processes, although it's still exploratory. I guess we haven't let Thomas speak yet. Apologies. But Thomas, on this topic, I don't know if that's anything you have come across through your time at Quantify.
So, I mean, in general, generative AI, the challenge with getting them to do new stress scenarios is they're applying the statistical patterns of the past to the future. So where it's very useful is if lots of people are talking about particular topics and you've got a good conversion between a new theme into risk factors, but that really requires a hierarchy of understanding how different credits relate, how sovereign risk relates to sectoral risk, and then down to individual credits. So it's quite a big challenge to come up with good scenarios. But from the point of view of, as an addition to checking that your stress test scenarios are sufficient, it's a good addition, because if you put in a scenario that's, let's say, not well founded, but it happens to bump certain sectors in a material way, and nobody's looked at that particular scenario, then of course that could highlight issues in a plausible outcome that could really occur. So I think, as Trevor was saying, you need to have oversight in terms of whether these scenarios are feasible or realistic components. And I think we shouldn't expect too much of them to be able to come up with scenarios that haven't been occurred to futurologists and others, but they may be very useful if given some human guidance. If, for example, you have a filter process, which is a question like, get me what people are most concerned about in credit risk, and then subsequently you pass those through to a request which is determine the risk factors affected by the scenario, and then you turn that into quantitative moves. Such a kind of multi-iterative step could give you rapid scenario generation.
Exactly. I think that's what I kind of saw. And, the tools that I've seen, they write the code. So traditionally you may have credit risk specialists writing SAS or Python code. Potentially these can speed that up or eliminate that human part of the process, but you'll always need judgment. One thing that I've heard from clients is this is moving very fast. It potentially is a game changer, but the model risk management part of it needs to be refreshed, basically, because, typically you've got model documentation and, a lot of requirements when it comes to model risk. So how do we take these models that are continuously changing and updating and refreshing into that process? So that's going to be an interesting development, probably a topic for another webinar. I think before we move on, there's a couple of more questions that have come in. Maybe over to you, Trevor, on this one. So credit officers in your institution, first or second line?
Yeah, I guess we're seeing a change. Traditionally, it was in the second line, but if we're talking about actually credit underwriters, they're now sort of part of the front line, and then you still have some credit management oversight, and then more setting the policy, and that the credit officers are usually the execution. So they're more like following policies, so they'll be working with the business, etc., with the RM if you're in institutional or whatever, and then working with those deals. But then the credit, or the traditional risk second line is writing, setting policy, judgmental, and reviewing those, and might even be doing quality checking, sampling, whatever that may be required. So that's sort of how it's more transitioned.
And providing or overseeing the controls and governance over the internal credit rating process as well.
Correct. Yeah.
That would sit in the second line. Michael Yap, how about in your institution? What have you seen?
In a way that for the particular the risk side, it is somehow being kind of organized in the way that that somehow the credit in a way that has evolved from the previous days, and now the credit is more on be it from a balancing between the second and the first line. So we do actually want to see more collaboration, and but we don't want to see a totally kind of a silo in the way that how credit and the business operate. And that's why we do have, that same applies to the risk. That's why we have actually the kind of embedded risk in every business unit, so that the things that is going to work is going to be more agile, and actually we kind of understand each body's actually the objective towards to achieve the common outcome. So that they have the common interest. So the kind of between the first and the second line is still need to be clearly defined as what is required from the regulator. But in a way that it need to be demonstrated in be it in the committees or the delegated authority that there are certain challenges that challenges to the decision or challenges to the thought process on how they come to the final decision. That is very important to kind of to be demonstrated along the way.
Yeah. And you brought up something interesting, like credit proposal preparation. I mean, to me, that's an area where a ChatGPT-like tool probably would be of enormous use, right? To write or develop draft credit proposals, right? Because I see a lot of repetition, at least in some of the institutions I work with. Another question on the Basel requirement. Again, yeah, there is that requirement on customer due diligence for certain types of exposures. That's something new that's been put into Basel. HKMA has got its requirements on that, and you can pull that up in their version of Basel 3, which is broadly aligned with BIS. Yeah, it's an additional kind of angle that's been put into the Basel Accord with regards, I think it's bank exposures. I don't know if you guys have any input on that or not. It's one of these kind of technical things within the Basel Accord that's been additional for credit essay approach, if I'm understanding the question correctly. If not, maybe we can move on. Been a very good chat so far, and we can switch gears a little bit. We've been talking a lot about traditional credit risk, or what some might call banking book credit risk. And maybe we can talk a bit more about traded credit risk and, you know, things like counterparty credit risk and establishing credit limits. But importantly, one of the key metrics that we look at for counterparty credit risk management is the potential future exposure and various derivations of that metric. Maybe Thomas, over to you. You can give everyone a very brief overview. I realize it's a highly technical topic. For some of those in the audience may or may not have interest in this, but it is good to kind of refresh everyone's understanding about modeling of PFE. I know when I worked on a counterparty credit risk internal model, independent validation, and we had to look at all the different scenarios and computational horsepower that goes into calculating the stress PFEs for various products, it can get highly complicated, but a very interesting area. And again, counterparty credit risk brought back into the regulatory limelight given the Credit Suisse situation. So Thomas, over to you.
Absolutely. So potential future exposure, just to give a quick introduction, is akin to a VaR-like measure, but for counterparty credit risk. So your exposure depends on how much positive overall portfolio position you have with a particular counterparty. And right now, you might have trades that are net positive value of 20 million. But if you look at a future horizon, say in a year's time or 18 months' time, typically, what is the distribution of possible outcomes that could be? So to calculate your potential future exposure, you need to essentially build a model for how markets behave and how they shift. So it's a simulation of different outcomes that could happen to the portfolio. And this includes making assumptions about whether hedges are renewed and other adjustments. Once you've calculated these different paths, typically by Monte Carlo simulation, we're going to create a distribution of different potential values, different potential exposures at the 1 year point. And then the potential future exposure is essentially taking a percentile of this, using the 95th percentile, so that you end up with a metric which tells you that, according to your simulation, in no more than 5% of cases should you end up with an exposure that is bigger than this amount. This is then highly useful for credit risk limits and other components, because it gives a probabilistic measure, a conservative probabilistic measure, about what the probability of ending up with a significant exposure is over a feasible horizon. like VAR, like the equivalent of market risk, this has complications with very, very small tail events. If you have an event which is a very, very big impact on the portfolio, but is a very, very small probability, say 1% or 2%, then because of the fact you're dealing with the 5% percentile, there's less sensitivity to the outcomes in that scenario. So it's not so good for determining how bad a loss you can get, but it is a useful metric. And because it's something which is not so dependent on the actual tail distributions that you're calculating, it's easier to check that your model is robust, to backtest it, and to validate it. So potential future exposure is a very important part of assessing counterparty risk from a perspective of all different kind of moves that could occur within that portfolio.
Yeah, excellent overview and explanation. It is also a regulatory requirement in many cases, depending on what type of exposures you have and what options you've chosen under the Pillar 1 framework. But it's also an area that requires a lot of computational horsepower in terms of computing, and most institutions run this daily, where traditional credit risk is, reassessed in many cases annually. So it's a very different thing. It's more along the market risk lines, but again, has a impact on credit risk management, particularly when you're looking at consolidation and aggregation of global limits for particular counterparty, where they could have counterparty credit risk and traditional credit risk exposure. Maybe Michael or Trevor, I don't know if you have any thoughts on this particular topic, and particularly given the recent volatility in the markets. What are you guys seeing in your institutions when it comes to counterparty credit risk management?
Yeah, I think I'll add on this. I think as Thomas mentioned, I think this is going to be in play in terms of, you're going to be running your stress test scenarios. You're going to be running this. It's going to help you support making decisions around limit setting, etc. Looking and we talked about before in the subject before about bringing in data and making, digitalizing the whole process. So this is going to be part of that, because when you look at, you brought a good point about the annual reviews. Now that's going to have to be, when we were doing the data transformation program, we were looking at to do that obviously, ideally on a daily basis, right? If you have all the data and you have all that. So I think with the new tools and the data coming in play, and this is an example one, where then you start to do your credit decisioning at a much more rapid pace and on a more regular basis. And then what's going to be key for risk managers is be able to set triggers and alerts and through all this, so that way so that someone gets alerted on whether any of these have been tripped up or triggered, so to speak.
Yeah.
So I think that's going to be, this is just an example one. This is what regulators may mandate for this. I can see that transition risk for ESG becoming mandated, and then having data and having simulation models as well. So I think this is going to be a common play now across many different aspects of credit or risk management, so to speak. And then that's how the new technology, new data is going to evolve the role of a risk manager.
Right, and I think one of the things I see is this kind of, well, it's counterparty credit risk, so it sits with the market risk team. But for some institutions, yeah, it does sit under credit risk, but maybe the inputs or the quantification of it sits somewhere else. But I do think it's really a credit risk thing, because even though the measurement is very different from traditional, you're looking at a 1-year horizon, or you're getting information typically every year. Financial statements come out every quarter that you use to measure your PD and LGD. Here you're getting changes every day, right, on the actual transaction, a derivative or a OTC exposure. So very different, but again, it all kind of funnels into credit risk and managing that overall exposure to a particular counterparty or client. Michael, I don't know if you have any thoughts or comments on this.
Yeah, just to add on to what Trevor mentioned, that I think if all of us are familiar on how this PFE, before PFE, how do we actually define the limits, especially for these particular products? I think it's kind of my first lesson when we look into this PFE limits. Prior that is when we look into, for example, some of the forex or kind of the commodity lines. So it's very important when during the origination time, what is actually on the back of the transaction, and that is why the hedging that are required on the back of the transaction. So once we kind of understand on this part, so whenever the PFE limits that come into place is something that it is not as kind of equivalent to some of the trade lines or the term lines in the different category, but these particular limits, once is going to crystallize, is going to impact the particular portfolio. So the thing is, these tools, the PFE limit is going to kind of add on the perspective on how the transactions is going to be originate, whether you need to kind of slice it to the different period, on how to get the best structure, the best risk, and the best pricing, so that we get the most viable outcome. Yeah, that's the one to back.
Okay. You know, for those participants, please feel free to pop in some more questions if you have any. We've got a few minutes left with the webinar, and we certainly will try to address those as they come in. I think the last topic we wanted to talk about, again, it's sometimes it's kind of grouped into credit risk. It's a nuanced area within the whole field of risk management, but one that's highly complicated and requires very specialized skills. And over to Thomas, if you want to just give a quick overview on XVAs. For some in the audience, they may not understand all the XVAs. I guess CVA is the big one. What do you do in this space? What do you think banks should be doing? And maybe just a high-level description of what's happening, or what are the XVAs that are currently in play for many of the institutions? Thank you.
Absolutely, yeah. So I mean, the big XVAs, CVA, DVA, FVA. So the primary ones. So credit valuation adjustment is accounting for the fact if your counterparty defaults, then contractual obligations that they owe you need to be discounted by the probability of not receiving them. DVA is the equivalent from your side. If you're on the brink of bankruptcy, then entering a agreement which could go favorably, extremely favorably, or extremely unfavorably, may be favorable in the sense that if you're close to bankruptcy, there's a good chance you won't have to actually pay off the negative outcome scenario. And FVA takes care of the fact that very few institutions have funding which is close to the collateral rate, the interest rates paid in collateral, or they're embedded in the discounting rates for risk-free valuation derivatives. There are other XVAs as well. So you have, for example, MVA, which accounts for the initial margin that may be required on the trade, or KVA, which tries to take account of the cost of the capital charge that will occur. I think when we think about volatile markets, how these are affected versus other risk metrics, within volatile markets, all risk metrics go up. I mean, your market risk is increased, your credit risk increased. If we think about a situation where we have a parallel increase in proportional increase in both implied volatilities and in credit spreads, then the thing to note with XVAs is a lot of them go up faster than the other risks, because a factor like CVA is dependent both on the exposure. So your exposure on initiation of a brand new trade, if it has a equal symmetric profile for gains or losses, will be linearly increasing if implied volatility is rising. Those products are also, if the credit spreads are going up of your counterparty, then you've got the increased exposure multiplied by an increased risk of default. So a lot of the XVAs, or similarly with FVA, if you have a situation where the exposure is going up and simultaneously you're getting an increase in the credit difference, the credit spread from risk-free rates, a lot of the XVAs have a quadratic dependence, or somewhere between linear and quadratic. So in volatile markets, you're likely to see a higher dependence on these components. And as described, they're complicated to adjust. So part of the computation difficulty is from the different paths that are involved, but also if you want to manage these exposures, if you want to know what a marginal trade is going to add, then you need to do a calculation on what the marginal impact of adding that is, and that requires quite relatively fast calculations, particularly if you're sell side and or you're looking for opportunities to act or offer to clients.
Excellent explanation. I don't know if Trevor or Michael, do you guys have anything to add in this space, realizing that it is a quite nuanced area within the broad topic of credit risk? No. Okay, so maybe I'll just leave it over to Thomas if you just want to wrap up on the topic of XVAs, and maybe you just want to spend 30 seconds or a minute to describe what Quantify does in this space.
Absolutely, yeah. So we're a leading provider of analysis for XVAs. So typically we're supporting clients, either banks or commodity firms or hedge funds in particular, which are wanting to know the impacts of the calculations. If you need to calculate these, you have sort of two broad options, which is either you calculate in-house, or you have a third-party provider like Quantify that helps you with the valuation of these calculations. They're complicated to create because of the different modeling perspectives of each risk factor, but in addition, there's a lot of need for computational optimization if you want to be able to look at differentials in terms of how the sensitivity to a particular factor will affect if you make changes to a trade position, what the marginal changes are on these XVA figures. So you can have an in-house team that's doing it, but in many cases that's not economic, and a third-party provider like Quantify is an efficient way to simultaneously have these calculations within your capacity, but also to keep up with changes and modifications in the regulatory or behavior and best practice.
Interesting question. When you provide these type of quantitative solutions to clients, do they need to go through like a third-party risk management or a model risk assessment process?
So
if the regulator shows up at the bank and says, okay, XVA, CVA, et cetera, and they have questions, then you will get involved to field those questions. Is that right?
Absolutely, yeah. So we've had that, and we've had that from CCPs asking some of our clients to validate that what's been done. That's quite common. The regulators do want third parties to be justified, but there is the advantage that third-party tools are used by a variety of institutions and also not optimized to, say, gain capital for a particular entity. So there are advantages in terms of regulatory awareness that this has been widely used by other counterparties. But it's absolutely, you need to justify that your validation is on a parallel level to what's been done for an internal tool, and that means providing documentation, explanation of how the methodologies work, and also justifying through testing of results.
Interesting. Well, look, I'm going to start to wrap up. It looks like we've got a few more questions that have come in. Will there be a recording? I'm not actually sure. We can ask Asia Risk to respond to that in a minute. Impacted geopolitical risk. I think we talked about that in the beginning. Most clients are factoring that in their stress test scenarios and transmitting that to macroeconomic variables and very targeted specific scenarios for certain types of geopolitical risks. For example, sanctions impacts on certain exposures. So I think I'll take this opportunity to wrap up. It was a really broad and interesting discussion. Clearly, there's a lot to talk about in future webinars when it comes to automated credit decisioning, model validation, and XVAs and counterparty credit risk management. I think we all agree that, we've come out of the pandemic, generally speaking, not too bad from a credit risk perspective, NPL ratio perspective, et cetera, but it looks like some of the lingering effects on commercial real estate are starting to play out. And we're looking at higher interest rates for an extended period of time, which is starting to work through the corporate and SME sectors, putting pressure on interest payments and therefore credit risk. So there's definitely going to be some turmoil coming up when it comes to overall credit space, which could impact loan loss provisions and credit risk models, stress test scenarios, as well as how we implement and manage credit risk. Not to mention, we spoke quite a bit about alternative sources of data, ChatGPT, and new tools that are coming on the horizon, which could be game changers. So I'd like to thank everyone. It was a great discussion. I look forward to doing this again. I think that's it. Thank you again. Have a good afternoon or good morning, wherever you are. Thank you.
Hey guys.
Thanks, everyone.
Cheers.
Thank you.
Thank you all.